Welcome to Wealth Management Mixtape, a go-anywhere show about life, finance, and investing. Join Jake Heisler and Tim Miller as they talk about what they're reading, writing, and experiencing. Jake Heisler and Tim Miller work for Quaker Wealth Management. All opinions expressed by Jake and Tim or any podcast guests are solely their own opinions and do not reflect the opinion of Quaker Wealth Management. This podcast is for informational purposes only and should not be relied upon for investment or financial planning decisions. Clients of Quaker Wealth Management may maintain positions in the securities discussed in this podcast.
Yeah, so Jerome Powell talking again today about interest rates, and obviously it's been hike after hike every single month. So I think we're expecting more of the same at this point. It just seems like they're never going to stop hiking rates. But I think the tone of what he said today was a little double-sided, where he's saying one thing of what he thinks they should do, but still saying that the 2% target of inflation is going to take some time to get down to that level. And there's a lot of uncertainty for the markets when Jerome Powell is in these types of situations where he's talking about trying to bring it down to 2%, but we know that obviously it takes time and it's a lag indicator, so it takes time for these things to feed through the economy to ultimately hit that 2% target. Will they pause in the June meeting? I don't know. What do you think?
Well, if it's if you believe the probabilities, then yeah, they pause, right?
I believe so too.
So I think he's got to bide his time, right? If he's talking today, things could change theoretically in the next 30 days or so. We mentioned truflation in the last podcast. I just pulled it up really quickly to see where it was. Last time we were talking about it, the truflation, which is like a real-time measurement of inflation, was at like 4.3%. And I just pulled it up this morning and it's at 3.15%. So it's gone from a year ago at about over 11% down to almost 3 at this point.
Yeah.
So we talked about it before, but the data that we're looking at is all backward looking, and so it's difficult to ascertain anything from those numbers, and certainly not a good gauge for increasing rates. So anyway, we've gotten upset about it in the past, but it's welcome news to see that they're considering pausing.
Why does it feel like the Fed are the only ones not looking at real-time measures of inflation?
Well, they must be, right? But they have to It
doesn't feel like it.
No, I know. We talked about this, I think, last time on the last episode, which was that they're stuck in this old way of doing things, and to change it now is to change the future, the whole system moving forward. And no one wants to be that person that creates this new paradigm shift, and therefore decisions are made in a different way relative to previous, administrations or Fed president, whatever it is. So it's I doubt it changes anytime soon.
Yeah, and there are a lot of different public figures who, big time hedge fund managers and so on and so forth are coming out and saying they should have stopped 2 hikes ago, right? But now you have somebody I saw Paul Tudor Jones, I think his name is. He's coming out and saying the Fed realistically, he's saying he sees Jerome Powell, what he wants to say, and then what he's actually saying. And he said they could basically declare victory of curbing inflation at this point in time. But he said it's almost definite that they're going to pause. Now, if they were to go ahead and hike again, that would be, I would assume, very bad for markets, right? Because they were already looking at the last hike as what is 25 basis points really going to do. But I think markets, as we know, they're forward-looking, and I think they're already starting to price in cuts later this year, early 24. I don't personally, just from what I've read and what I've listened to, believe that they're going to start cutting later this year. I think that's, the way we've kind of seen the narrative from the Fed to this point, it makes me, it makes it hard to believe that they're going to start cutting in the same year.
Well, I think it's probably dependent on if you see a recession, in the future, and if you see it, when you see it, right? So
Yeah.
if we all of a sudden have negative GDP in the third and fourth quarter, and unemployment is spiked by to 5% or 6%, there could and probably would be cuts at that point. But if that can gets kicked down the road to 2024, then cuts aren't probably happening until 2024. They're coming. That's the reality of how this system works.
Yeah.
But you're right. The market's forward looking, and I think that's a good thing to remind people of. That I think, based on all these channels just completely focused on the market day to day, they try to link the news cycle of today with the market movement today, but it's not the case. If it happens, it's probably accidental, honestly. But they love when it matches up perfectly, right? When those two things match up perfectly. So to your point, interest rates, the markets are forward looking. The bond market's pricing in lower rates in the next, 6 to 12 months. But rates can fall in expectations of a recession a year from now. So, and it can fall today in expectation of that. So rates could be, measurably lower at the end of the year, but not because the Fed cuts them, because there's an anticipation of a cut coming maybe in 2024. So I would agree with you. I think that the higher likelihood is probably 2024, but who knows?
Yeah, we'll have to wait and see.
And the other big thing is the debt ceiling coming up here. I mean, it seems like this is like a skipping record, or CD, I guess, though we don't have any of those anymore. So,
like percent chance of this actually happening as a default, right? It has to be close to zero.
The way I've always looked at these events is super low probability, but high risk, right?
Extremely high risk.
So you don't want to make rash decisions on really low probability events, but you want to be prepared for high risk events, right? So what does that mean? That means that from a personal financial standpoint, you want to have cash reserves available. You want to have a balance of actual cash assets and money market assets. Because money markets usually are backed by treasuries, right? So we're talking about default. That's a problem. It could be a problem. I agree that it's probably not going to happen. There's going to be some sort of resolution, at the tail end. But the Fed, the Treasury they're running out of money, and quick. I think it was down to like $46 billion last time I looked, which sounds like a lot of money, but in the scope of the entire U.S., interest payments, Treasury payments, and other obligations they have, Social Security, et cetera, government employees, it's small. It's a small number. And I think most major institutions are preparing not on the default or that the debt ceiling doesn't get raised, but the fact that there's going to be this scramble at the last minute to find the cash to make these payments, if that makes sense. So that's a bigger risk, bigger probability risk than the actual default or not having a resolution of the debt ceiling.
Does anybody know the actual date of when this needs to be resolved by?
I guess Janet Yellen came out and said it was June 1st. So that's what, 12 days away?
They've said June 1st. They've hinted towards the middle of the end of June. It's like, does anybody really know the true date? I don't know. But
back to the idea that I don't know how many you've dealt with as you've become a financial advisor, but it seems like it's the same thing over and over again. It's political posturing all the way up until the moment when they all of a sudden come to a resolution and they raise the ceiling.
Yeah. That doesn't really help our clients' nerves, though, right? Everybody's going to have that bit of panic, even though it's a low probability type of event. Just the headline news alone can be unsettling for a lot of folks.
We could talk through the ramifications of it, right? If we just kind of think out loud here, but right, it's low probability. Let's just say that for the record. And it's probably more bark than bite. There's just going to be headlines everywhere about it. As both sides are posturing up until the deadline. But if the U.S. defaulted on their debt, right, that's global implications.
It's bigger than the pandemic.
Yeah, right. It'd be a really big problem. But at the end of the day, our treasuries, let's say we defaulted, right? It might be a default. Again, worst case scenario, they default, and then they get a resolution, right? Because the fallout's so extreme that it has to be resolved immediately, and it is. Our treasury is still the safest assets? That's the question. And probably, I mean, relative to other currencies and, and other, central banks, I would say probably, yeah, it still is, right? Aside from having cash or, some people would think gold, that sort of thing, but having something tangible. But I don't know, is it still the safest asset, even if there was a default? And that's kind of where my mind is going. Is there, what's the alternative if there's a default? What's the next safest place to go?
I have no idea. I would have to agree with you that I still think it's the safest, even if there's a default, because even in the event of a default, you're right, it has to be so quickly resolved to stop whatever harm they've caused with the default that it's still going to be the safest asset.
Yeah. Ray Dalio apparently has been asked a bunch of times about what he would do in the event of this debt ceiling. And of course, he has this long-held belief that there's these broad-based cycles in the economy, world economy, and that ultimately the current kind of champion of the world economy gets supplanted by somebody else, right? So the U.S. now is the kind of the center of the world economy, and that at some point will change. And one of the reasons it changes is because there's such significant debt that you get in this cycle of printing money to find a place to pay or find money to pay these obligations. So his point is like there has to be a broader based solution here and a bipartisan solution that doesn't just address the deadline, the ceiling itself, but the ingredients that create the problem in the first place. And so he talks about the political environment being so extreme, left side, right side, trying to shout about their ideas, and that really it's the middle that has to come together, almost like a third party, and figure this thing out beyond just the deadline, right? Not kicking the can down the road. So he goes through this kind of rationale of what happens, why this is such a problem over time, and I thought it was really, really interesting. He said, I'm just going to read it because he writes much smarter than I can speak for sure. Is when debt assets and liabilities reach the point that the amount of debt sold is greater than the amount of debt that buyers want to buy, central banks are faced with a choice. Either they have to let interest rates rise, right, to balance the supply and demand, which is crushing the debtors in the economy, so it screws up the economy, or they have to print money and buy the debt, which is also inflationary. And so it encourages holders of the debt to sell the debt, which makes the debt imbalance worse. It's like this revolving, there's no real clean answer unless you come at it from a different perspective and treat the country like a business, that the money you're taking in, tax revenues and other smaller areas, has to outweigh the money going out, your expenditures and debt payments, right? That's the way that you change the course of what he's calling the world powers, and put a stop to a turnover in that world power hierarchy. So it's just so he's saying the way he'd come at it is get a bipartisan support and attack the problem, which is not a short-term issue. You have to take time to do that, and that's okay because you have to get it right. The ceiling he'd get done right away, kick the can down the road, but then with a caveat of, getting things in a bipartisan way and coming at the debt from a few different angles. It's a little scary the way he lays this out. We've talked a little bit about it in before, but in prior podcasts.
I think it sounds good in theory. Right? Like everything sounds good that he says, and I agree with just about all of it. But actually putting this into action, it sounds nearly impossible, right?
I would agree, yeah.
I mean, when's the last time that the U.S. was at a surplus instead of a deficit? I think we looked at it earlier. It was 25 years ago, 30 years ago at this point.
Yeah.
And
that was temporarily. It was 1998 to like 2001, and then 9/11 happened to forget it, right? We started spending money like crazy, and hasn't reverted back since then. So,
and I don't foresee that trend reversing anytime soon. And now you have, as you just alluded to, was the extremes on both sides. Is it really more likely now than it was in the past 2 decades to find some type of bipartisan support for a plan to run the U.S. more like a business, which inherently is going to cause spending cuts, right? So it's, you just had the pandemic and you're still had all the money in the system for that. People are getting used to flowing money in the economy. Is it going to happen? I would guess probably not. Does it sound good? And do we all kind of agree it should happen? Yeah, I would say we probably would. But I don't know. A lot of what Ray Dalio outlines, it just seems like, I don't know how it's going to be feasible, at least in the short term.
Well, then that's what he says. The probability of it actually happening is so minimal, even though that's what has to happen, right?
Yeah.
In order to solve this thing. It's just a mess, and it's like the elephant in the room, but everyone's okay with the elephant being there. And the problem is there's incentives. You have to look at incentives from our elected officials, right? Their incentive is to get reelected, and so that it creates these extreme environments in the way that our elections work that aren't about the greater good. Or taking into the entire collective of the United States economy. It's about how do I pander to my constituents so I get the next amount of votes so I can stay in office, over and over again. And so meaning there probably has to be reform from an election standpoint, which is also not going to happen because it ruins these career politicians or the chance of them being career politicians in the long run. So we talked about it before. It's a mess all the way around, but there's no incentives to get it to work properly. So really, it has to blow up. I mean, that's the unfortunate thing is there has to be this catastrophe to incentivize a solution, right? It's a shame that it has to get to that point, but that seems like what would have to happen in order for there to be a real resolution on this moving forward in the way that Ray Dalio is explaining.
Yeah. Well, let's hope that it doesn't come to.
Yeah, go ahead.
I'm just going to say, let's hope it doesn't come to the default and then the resolution. Let's hope something gets, as Ray Dalio alluded to, which is kicking the can down the road with the caveat. I think that's what we're all kind of hoping for. But we all agree something has to change.
Well, maybe ChatGPT will be on the ballot in a couple of years. We'll see.
You never know. Yeah, speaking of ChatGPT, it just got actually uploaded into the App Store. Is that the correct terminology, right? It's fully integrated as its own app now, which I'm still trying to figure out the difference between the I think 3.0, like the normal ChatGPT, and then like the plus version, which is what ChatGPT 4.0 or whatever it is. Yep. Like, what are you getting for that $20 a month? I have no idea. Do you know? Do you know what the extra
I guess
benefits?
You're getting the smarter AI.
Does it have like plugins? Does the first version not have plugins?
Sure. I don't know. I don't know what the plugins are built off of, but I would assume it's ChatGPT 4. It's just more intuitive, right? That's the idea. Yeah. It's these large language models are as they're getting tweaked and they're more intuitive or able to answer questions or analyze problems in a more intuitive way. That's the new version. So I know we talked about it before, but I think you said you saw a podcast that you thought was interesting.
Yeah. So I was actually listening to a podcast with, I think it's called the Prof G podcast with Scott Galloway, where he discusses the potential, both positive and negative effect of artificial intelligence. Now, he was focusing more on the section that I listened to. I didn't get through the entire podcast yet, on the potential positive impacts of artificial intelligence. And I think, as I'm doing right now, I think we're all kind of doing, is just trying to understand like you just mentioned, large language models, generative AI, all these terms and buzzwords that are being thrown around. Like, what are they? What do they mean? So when talking about generative AI, a form of generative AI, as you just mentioned, large language models or LLMs, they're defined as an artificial intelligence algorithm that uses deep learning techniques and large data sets to understand, summarize, generate, and predict new content. So that's effectively what ChatGPT does, where it's taking your inputs, it's learning from your inputs, it's learning from all the data sets where it's getting its information from, and it's just getting better and better at learning from those large data sets. So a couple things that he thought about, and I guess there's a couple different surveys that he took into perspective when talking about on his podcast. But I thought it was really interesting. One thing he mentioned was there's a study conducted by PwC where they believe by the year 2030 that AI would contribute up to $16 trillion to the global economy. And of that $16 trillion, $7 trillion would come from increased productivity in our labor force. So I thought that increased productivity was substantial. When you're talking about the U.S. GDP in total is $23 trillion, and you're talking about AI generating an additional $7 trillion in worker or labor force productivity. I thought that was pretty powerful. And then he also goes on to say that the World Economic Forum estimates that by 2025, so 2 years from now, that 97 million new jobs will be created across 26 countries compared to the 85 million that will be displaced. So as we were talking before the show, that's a net positive of 12 million new jobs. Now, across 26 countries, that's not a large number, but I think there's this overarching fear of this huge negative impact and the negative ramifications on AI. So while it might seem marginal across 26 countries for 12 million jobs, I think I'm focused more on the increased worker or labor force productivity that AI is going to be able to enhance the labor force by. So I thought that was pretty powerful stuff when trying to think about what are the potential impacts of AI. He also, just to kind of conclude his thought, was talking about as humans and in our human psychology and human behavior, we're wired to see the risks more than actually being able to understand potential future benefits. That's just going back historically, it has always been the case. And it's been no different with this so far, right? We're always looking at how is this going to be a disruption to our current lives rather than what are the potential benefits of this enhancing, the way we currently live.
Yeah, and I wonder, I didn't read the study or listen to that, but I wonder if it's based on the current technology or if they're trying to do some projecting. Because I don't really know, I mean, it comes from PwC, but they're math-based, right? So they're trying to figure out these numbers. I mean, what are they using for the advancement of this technology over time? I'd also be curious to see if this is adding to total income at the human level, or if it means the productivity is coming from lower labor costs. Even though there's more jobs, the labor cost that they're having to pay is lower. Therefore, the quality of life is actually lower relative to that. So I would agree, the productivity has to be there because this is more efficient in a lot of ways if harnessed the right way. But I wonder if it means less high-paying jobs, if that makes sense.
Yeah,
I don't know. We'll see. Yeah, we'll see. And I think it's just so hard to project what this looks like. There's going to be positives and negatives, right? And it's like anything, any new technology. If we look backwards and the internet and all these kind of things going online, and we would have probably predicted that a lot of jobs would have been lost because of mom and pop shops going out of business and et cetera, but that's not what happened. We gained a lot of jobs as a result of these new industries. So that's possible too.
Yeah, it's going to be interesting to see just in the next, because it feels like it's advancing so rapidly. It's interesting to see what's going to happen, not even 5 years from now, but the next 2 years, right? The next 12 months or 18 months, whatever it is. I think it's gone so fast from where we're just hearing about this at the end of last year, or really beginning of this year, 5 months ago. And now we have, it seems like in every single earnings report for every large company, they're saying the word AI probably 50, 60 times, every single company, right? And the ones who are at the forefront of AI, they're the ones who we've seen their stock prices jump over the past month or so. So it's already happening like materially with the markets.
Yeah, yeah. And that, a lot of those companies were in the Nasdaq, right? So we wanted to touch on this kind of divergence of performance this year too. So in a large part because of these this kind of the releasing of these AI large language models with ChatGPT and Bard on Google's side, and there's a couple others along the way as well. But we've seen this huge divergence in performance this year, right, between the Nasdaq and the Dow Jones. Nasdaq, of course, is more growth-focused, technology-based companies. Dow Jones are your old, boring companies, if you want to put it that way, right? And so, and it's literally the opposite of what happened last year. So I know we have a couple of charts that we'll show here, but last year, well, why don't you run through them, Tim?
Yeah, so last year, the divergence was in favor. Now, the market was down, but the divergence was in favor of value stocks, which we'll refer to as the Dow Jones weighted stocks, where it was down. Let me zoom in here. It was down roughly 8% for the year, right? So the Dow Jones, when growth really got crushed and was down close to 33%. So we're talking about a 25, 26% difference in performance, where that same performance of 20, 24, 25, 26% divergence in returns has flipped. Now, that was 2022. In 2023, now I know we're only 5 or 6 months in at this point, but it's almost exactly the opposite, where large cap growth or the tech stocks, as we already alluded to, is up 26, almost 27%, and value or the Dow Jones is up only about 1.5% to 2%. So another 25, 26% diversion in returns from the 2 years. So we'll see where it goes the rest of this year. I think a lot of folks are kind of in the same boat, that they think that tech is going to lead the way this year in 2023, but I don't know. What do you think? Where do you think tech goes from here? Do you think it remains the same theme through the rest of the year, or do you think it starts to revert back to value at some point this year?
Well, I think whenever you see this kind of divergence like this, you see a reversion of the mean in some material way. I just don't know. I couldn't put a time frame on it. Everything is kind of linked right now to interest rates and the Fed. So with the expectation of interest rates falling in the future, it tends to be good for high growth companies, right? If the opposite, if interest rates stay higher, that could potentially favor less cyclical companies in the short term. So I could see this depending upon the Fed's course of action, and if we ever hit a recessionary environment in the near future, it could go either way. So I think, a recession, you're going to see probably a pretty simultaneous pullback. But if rates start falling or the Fed starts cutting rates, that should typically, growth stocks will bottom before value stocks. That's the way it's worked historically. At the end of the day, what this tells me, right? If this giant divergence 2 years in a row so far, is that look, if you're lucky, you've timed it right? You've switched from one to the other, but the odds are you're not one of the lucky ones, right? So it goes back to the diversification and having an equal weighting or somewhat balanced weighting in your portfolio to take advantage of these. The only assurance you have the top performing asset class in your portfolio is by owning it most of the time, right? And so I know we talk about it a lot, but it's a reinforcement of that concept that things can move very differently at different times, and these last 2 years are great examples of that.
Yeah. Now, kind of final thoughts on this topic, but don't you think that if the narrative persists of rates higher for longer, wouldn't that signal to growth stocks in particular that they got ahead of themselves?
I would think so, yeah.
I mean, personally, I think there's a real chance that rates are higher for longer, just based on everything that we've kind of thought was going to happen with rates. I didn't think they were going to hike the last two times they hiked. So, I mean, I think what the market's pricing in is that there's going to be cuts sooner than many people expect. And that's what it looks like these growth names are pricing in as well. It's a mixture of AI pricing in future cuts. But we'll see.
Yeah, we'll see. So, there's a lot going on. I can't remember a time, I mean, these last few years has just been crazy. And this is all the fallout from all the COVID stuff kind of rearing its head now. We'll see where it takes us. It'll be a bumpy ride, I'm sure.